Hi Mortgage Heroes, Andy Cruz here in Business Development, and this is your weekly video newsletter. And this week we're going to talk about the new stimulus package that is just days, if not only a couple of hours away from getting approved. You've probably already seen the headlines. It's in total a $1.9 trillion package. And we're going to expect an infrastructure package after that. So let's take a minute really quick and let's talk about what's going on and how that affects housing and how that affects mortgages. So first, let's talk about the stimulus package and what's going on. Well, our Treasury Secretary, Janet Yellen, has recently been saying, hey, we need to do this. Everyone knows we need to do this. And I'm also not worried about it. I'm not worried about inflating our national debt by another $1.2 trillion. And that makes us kind of go, well, why? Shouldn't we be worried about that? Now, the other thing it kind of makes us wonder is, isn't that a reflection of how bad things are? I know that with any type of large government spending, there's always additional things that are thrown in there to the tune of millions, or in this case, billions of dollars that are maybe only somewhat associated, or in some cases, not associated at all, with the main problem that a bill achieves to accomplish or to solve. So, in this case, it is a little bit concerning that you have the Treasury Secretary kind of being like, no big deal, it's only $1.9 trillion, because it is an indication that there's a problem. And that is going to have a ripple effect in the housing and the mortgage industry. And we'll talk about that in just a second. Now, on the other hand, you have the Fed chairman, Jerome Powell, saying that, hey, the Fed cannot raise rates. We're focused on inflation. We want to get inflation. We're going to let it run hot, as he says, to 2%, which means that goods and services that we buy as consumers are going to be more expensive. You've probably already seen in just the last couple of weeks that gas prices have gone up. Some of the items you buy on the shelves at the grocery store are starting to creep up in price, and that's okay with the Fed. Now, that's okay with the Fed because what they're hoping happens is that will spur on short-term lending. Now, a lot of you already know this, but when the Fed reduces their rate to 0% to a quarter, or they raise it to 0.5% or 1%, when they raise the rate or they lower the rate, that's for short-term lending. That's for things like credit cards, lines of credit, car loans. That's not your mortgage. Now, I know you've seen lots of bad marketing out there that says, oh, the Fed reduced their rate. You should refinance today. Actually, has nothing to do with it. What actually has an impact on the mortgage industry when it comes to the Fed's participation is them buying mortgage-backed securities. So mortgage-backed securities are exactly what they sound like. They're financial instruments, securities that are packaged together, and the asset that it's connected to are mortgages, which is your home. And those are sold on the open marketplace. So the MBS, the mortgage-backed security, is a security that is sold on the marketplace, and the Fed is buying them up by billions of dollars per month. And they've been doing this since the CARES Act back in 2020 when that came out. They committed to buy $120 billion a month of bonds, and 80 million of that is specifically mortgage-backed securities. So what you've seen happen is rates come down in the marketplace because the Fed is backstopping almost the entire industry. Not single-handedly, I'm not going to give them that much credit. But it's not the banks alone that are causing rates to be low. It's a reaction by the banks to take that low rate that we can offer the consumer, backed by the Fed's participation in buying all these securities, creating tons of money to lend to you, to buy, to refinance, to do your cash out, reduce your rate and term, and that's why rates were so low. But then you have to ask, well, what's happening now? How come rates for the last couple weeks have been ticking up, Andy? Well, the bond market is its own marketplace, and the Fed doesn't trade in and out of the bond market. They're not a trader, but there are traders in the marketplace. There's money market managers, there's fund managers, there's investment firms, hedge funds. They trade in the bond market. And when you see the confluence of massive money being sent out to people, which will cause inflation, and you have a lot of unemployment still that's going unaddressed. You have forbearances by the million still. I think the last number I saw was 2.7 million mortgages in forbearance still. The eviction moratorium getting extended. You start seeing all these little pieces come together and you go, okay, well, wait a minute. The bond market on its own cannot sustain the lowest rates in history forever. even with the Fed's participation. And that's what you're starting to see. You're starting to see the confluence of all these variables come together. And what's been happening the last couple of weeks? Rates have been affected negatively. They've gone up by 1/8% to 1/4%, depending on your scenario, your loan program, where you live, meaning like if it's a rural USDA loan or it's a single family dwelling. There's pricing differences, believe it or not, just in the loan program, of course, but even the type of home sometimes. What you're seeing now is a market reaction due to all of these influences and variables that have been coming together just in the first couple of weeks in the brand new administration. Now, these problems do span back all the way to 2020 when you initially had to do the lockdown, you initially had the CARES Act. So yes, all this has kind of been coming up and we've been knowing for a long time this is not gonna last forever. I've been telling you, hey, lowest rates in history are always in the rearview mirror. You always see it after the fact. And right now I'm kind of talking to you in a little bit of an after the fact manner because those lowest of the lows ever were now behind us. Will they dip back into those lows again? Perhaps. However, given the state of everything I've talked to you about today and all of the pieces moving together, it is unlikely that that is going to happen with the snap of a finger and it's going to be tomorrow and the next day and the next week and the next month. I honestly think what's going to happen is as the Fed is letting things run hot and they're going to allow inflation to go to 2% in general, and you have the Treasury Secretary kind of being nonchalant about how much spending we're doing to keep things going. It really honestly is a reflection of how bad things really are under the surface, regardless of what the headlines say about the recovery going great, and regardless of what economists say about the stock market, and it's flying and soaring to new highs, which, by the way, it just seems to be completely detached from actual corporate and company value. That's a whole different video for a different day. But I'm just telling you this because all of these things matter. When you see these things in the news and you see these things, even if they're at different times and in different places, when you step back and you put them all together, you can kind of see what's actually happening. And we're already starting to see those rates change on the rate sheets every day. It became very noticeable at the end of last week. This week, there's a continuation of it. There is some volatility in the market. And if for some reason you were left on the sidelines and you were unable to refinance or you just chose not to, you can still do that now. It just may not be as good as it was 2 months ago or even 4 weeks ago. Now, that is still better than waiting now to see if they're gonna come back and it actually goes against you and gets higher. And I'm gonna end today by telling you a quick story. Many years ago, I had a client and he was very indecisive about when he wanted to lock his loan. Now, back at the time, I didn't have access to all the tools and resources that we do now, and they weren't actually very much commonplace for interacting and doing loan locks the way we do them today. And one day we were having this conversation, and it kind of went like this. Client says, Andy, I'm not sure if I should lock my loan today. What if they go down tomorrow? And I say, well, you can wait and hold your breath, and if they're lower tomorrow, we'll lock. He goes, yeah, but if I don't lock and they go up tomorrow, then I'm gonna be mad that they went up. I don't know what to do. But I'm gonna be mad if I don't lock, or I'm gonna be mad if I lock and they go down. And I said, okay, listen. I said, I'm asking you a question. Which way do you want to be mad? Tomorrow when you wake up, which way do you want to be mad? Do you want to be mad that you locked your loan today and it's lower in the morning? Or are you gonna be mad that you floated in wait and you didn't lock your loan and it's higher? And really, that's the same question I want to ask all of you today. And anyone else who is watching this and this was sent to you by a friend or a family member is, at some point you're gonna have to decide which way you're gonna be happy and which way you're gonna be mad about the outcome of the process, because the market is the market. We've got heavy-handed Fed involvement, heavy-handed Treasury Secretary involvement, or government spending involvement. There's a lot of massive effort going in to making this thing still work. And we're already starting to see that it's going up and rates are gonna increase even despite all those things. So ask yourself, which way do you wanna be happy in the outcome of your loan? And which way do you want to be mad? Do you want to lock today and it's lower tomorrow? Or do you want to float and it's higher and you wish you would have locked when you could? Thank you guys for watching this week's video newsletter. As always, please like and subscribe. Make sure to send this to a friend and family member who might need this information to make their next right choice in real estate. Thanks for watching, and we'll see you again next week.